G'day, it's Scotty presenting Real Wealth Program. Thanks for joining us on our August 5th week special bonus session. So on the months with 5th weeks, we get to throw in another bonus session on a Thursday night, and that is tonight. So that's really cool. All right, so we are talking about structuring, and it's a question that we commonly get asked. So whether it's something from buying your own home or investment property, right through to partnering with others, as in partnerships or syndicates, renovations, developments, flips, options, all that sort of stuff. So we're talking about that this evening. I need to put a disclaimer up front. I am not your lawyer. I'm not your accountant. I'm not your financial planner. I'm not your mortgage broker or anything like that. So this advice isn't advice tonight. Anything that you hear is general advice only, and we're talking about general market conditions. We'll be talking about things that I've done personally, things that we've seen our clients do, and of course, things that we've seen others do. This is not specific to you and your requirements and your needs. So now that disclaimer is out of the way and ASIC and APRA are no longer knocking on my front door, we can kick off. So we're going to start with buying our own home. All right, so obviously there's a lot of people on our program, and they range in experience and skills, okay? And with that comes very different questions, but they're always the same thing. How are we going to structure this? What are we going to do? Should I buy it in a trust? And you can get asked that, from first or second homeowners, and you kind of go, nah, like that's not where it goes. So buying your own home's pretty simple, right? It's, if you want to take advantage of capital gains, the free capital gains and that sort of stuff, you've got to buy it in your own name. Now, we're going to go through each scenario, and I'm going to list you the pros and cons. Now, it's not going to be a complete list. It's just going to be stuff that we've got written down that's going to pop into my head as we go, right? So buying your own home, the pro is it's easy, okay? It's easy in your own name. It's easy to get financed. The banks have you tied up. They know everything about you. They have the property as an asset. They have you as guarantor, and they have you written all over the transaction. Your name's on the contract, your name's on the title, you're everywhere. So you are highly, highly involved in that, and that is pretty straightforward. So let's just put that to one side at the moment, because your own home is not really what we do at Zenium. We do investments. So let's talk about that. All right. One thing I will say is that if you talk to a lawyer or an accountant or a financial planner, you're probably going to get three different opinions on how you may structure something. The lawyer is going to structure it in such a way that you're completely protected from an asset perspective. Okay, so it's going to be 100% locked down, and perhaps for generations to come, and there could be 16 layers of paperwork and whatever. I'm not saying it's a bad thing. I'm just saying lawyers will review it from an asset perspective, an asset protection perspective. So it might not be the simplest, and it might not be the best for tax, and it might not be the best with superannuation and other bits and pieces, but it will probably be the absolute best for asset protection. Your accountant will, of course, focus on the tax minimisation, and they'll probably think about the asset protection, other bits and pieces, and of course cross over to financial planning strategy. They'll bring their planner in and all that, but they will 100% focus on tax minimisation. So it could be the best for tax, but it might not be the absolute best for asset protection. And then financial planning will take into retirement, some things. Maybe it could be to do with structuring things in a certain way so you still get a pension in an old age or that sort of thing. So they're going to view things that way, okay? What you're going to do is, just because you get three different answers, you have to choose the path that's best for you, and you're going to have to work with those three advisors to get the right strategy and the right structure. So that's my discussion about that. So I'm none of those for you guys, but we'll talk about each thing as we go. So you've got your own home and you want to buy an investment property. Okay, what's next? Most people would probably just say, okay, well, we're going to buy an investment property. Maybe you got married, you've got a spouse, etc. So let's go and buy it in joint names. Okay, so you trundle down the street, go to an open home, see an agent. Wow, great property. All right, 500 grand, let's buy it. Yep, sounds good. Name on contract, Scott and spouse. Okay, so that's one way. All right. Obviously, the pro is it's just as easy to do as your own home. The con is that property now is another liability under your own name. Okay, so should you buy it in as a partnership? Well, that's a question we often get asked, and for that, I'm going to throw over to our guest presenter tonight, who's just joined us. Todd, you logged in, matey. You got video? You got audio? All right, mate. You get yourself sorted. So, what happens is you got your own home. You go into investment property. So, should you buy in your own name for an investment property, or with you and your spouse, or should it be like joint tenants in common? Should it be a partnership? All those things. So that's where we're going to head with our next thing. Todd, do you see those buttons down the bottom of the screen where you got mic on and off and cam on and off? You need to hit them. Yeah. Oh, you're there. All right.
Sorry, I had some technical difficulties.
Oh, that's okay. All right. So we can hear you. Have you got webcam? Or you got pants on, or are you going to leave webcam off?
I can put it on if I want.
Yeah. All right. Because then it looks like I'm actually talking to someone.
Okay.
All right. There we go. Okay. Hello. See, so for all you guys that are watching this at the moment, I wasn't making up. Todd is a real person. He joined us tonight. So there you go. So Todd, we've just covered structuring for our own home, which is straightforward, right? It's in your own name, and there's capital gains and all that sort of stuff that you get advantage of. Now we've got some equity behind us. We're going to buy an investment property, and the most common thing is that do you just go and buy it with you and your spouse? But sometimes we get asked, well, should we put that in a company, or should we do it as a partnership? And so what I want to touch on, and for everyone's quick background here, is Todd is a finance guru. So once again, all those disclaimers at the start. He's not a lawyer, he's not an accountant, not a financial planner, but he will be able to talk to us about how banks view the different structures. And I think that's really important, because you've got to talk about those structures with those finance, with lawyer, accountant, and financial planner yourself. But we need to know if the bank's even going to give us any money. So Todd, we've got a couple, they've got a house, they're going for an investment property. Now there's two options straight away. They can buy it in their own names together, like, tenants in common, etc., joint tenants. They could do it in a partnership, or they do it in a company. Tell me why they would or wouldn't do it in one of those ways.
Well, I guess it depends on their advice from their accountant. But to give you an example of how a structure can impact your borrowing, and particularly your borrowing costs, there are some banks that just will not provide you finance if it is in a company and trust for an investment property. Not many. I mean, most will. But what some non-banks will do, for example, is they'll increase the interest rate to lend to a company in trust as opposed to an individual. Their reasons for that are their own. I guess it comes down to perhaps administration, and if something goes wrong, they're going to have to, they can't just come straight after the people, they have to call on guarantors. So if you're a director of the company, you'll have to give a personal guarantee. And as a partnership, look, partnership wouldn't really be particularly beneficial. I don't see why you just buy as joint tenants.
Yeah.
Most of the time, you've got two situations. One is that we expect that we're going to turn this property or properties into some kind of going concern business. That is, the business of investing or the business of developing. And as a result, we might want a separate entity. We might want a separate company as trustee for a trust, because using a discretionary trust, we can take profits and income and distribute that income to our nominated beneficiaries.
Yeah.
So we might be nominating other people or other entities to distribute the income, rather than taking it ourselves, which we'd have to do, excuse me, as a joint tenant or as an individual owner. And I'll give you an example. So I have a client who runs a very profitable business, and those profits are distributed to a number of other companies through a trust, and those companies and trusts hold a number of investment properties. So the depreciation that they get as a deduction kind of reduces the business profits. I hope that makes sense.
Well, so the income's being dispersed through that, and so then it's a tax deduction in those individual companies and that hold the property, right?
Exactly. Yeah.
Yeah.
So the business might make, let's say the business makes $1 million and they would normally pay $300,000 tax. They're taking that million and they're distributing it to a number of different trusts, and those trusts hold residential investment properties for which they get deductions.
Yes.
So if they're losing money, for example, then that comes off that profit, and as a result, it pays less tax. So, I mean, that was some fairly smart structuring. If it's just a case of, well, we want to buy an investment property, you probably should talk to your accountant about, from a taxation perspective, which is the best way to do it, because you might have one partner earning a lot of money and another partner not earning much, and you might like to distribute that income in a different way. In terms of going to a bank, as I said at the start, it really comes down to some banks will charge more for that different legal entity, and you just have to be aware of that. Particularly if you're, say, an overseas buyer, someone, a non-resident. Many banks struggling to provide finance to non-residents or Aussies that are expats, and we had one recently where we had an Aussie citizen overseas, and he wanted to buy the investment property in a company and trust because he and his brother were doing it, and the number of banks, probably 4 out of the 5 banks we spoke to, would not lend to that entity because he was an overseas borrower. They wanted it in his personal name.
Right. Okay. All right. So we've got our own home, we've got an investment property. So the simplest way to get an investment property is as a single or a couple, just to do your own names. But there's difference in, as you touched on with your talking to your accountant, is like if one earns substantially more than the other and it's a couple, then you need to consider perhaps structuring the ownership of the property in relation to that as well. So if we want to explain that, so say that, let's do a really extreme, say there's a couple, one's in a really good paid job and one doesn't earn any money, so to speak, then the question would be, would you own that property 50-50 or would you own it in a different split? Because then those gains from the property and the rent from the property, any of the rental income, would be split differently. And because, of course, you can split anything from 50-50 to 99-1, right?
Sure. And what I would expect to see in that situation is that the couple would come to us for a loan, and it's more likely that we would be buying the property in the person's name that is not earning an income, assuming that it's cash flow positive and we're going to get some cash out of it, right?
Yeah.
If it's a negative situation, then you'd be putting it in the other name to reduce their tax. But I would expect if it's generating cash, it would be in the other, the one partner's name that has no income. Now, you can buy a property in one name and have the loan in both names. So in that situation, of course, if partner B with no income comes along and says, well, I want to buy the property, the loan cannot be in that partner's name only because they don't have any income.
Sure.
So you do the loan in two names and own the property in one name so that the income's distributed to that person. You cannot do it the other way around. So you can't have the property in two names and just have the loan in one name. And the reason is because the property is owned by two people. And so, in terms of providing security to the bank, there's no link between the two parties back to the one loan. Now, in the past, we might have done that as a guarantor loan. We might have said, oh, well, partner A can guarantee it. But in recent times, that policy has changed where banks will want to see, well, what is the financial benefit of that person, being a guarantor to this loan. So
Yes.
it's not that it can't be done, but it's more likely that most banks will want the loan in two names and the property in one, and not the other way around.
And that's good. And I think you touched on a really important point that we get caught up in a little bit with some clients is that they have that situation where one partner earns a lot more than the other. And even if they do a loan of, the property is 50-50 or 991 or whatever, the problem that they always come to is that this property at the moment might have deductions or be negative geared, but no one loves that idea for forever, right? So with the whole view of within 10 years, this thing's going to make an income.
Yes.
So they're sort of saying, well, hang on, I want the tax deductions at the moment for the high income earner, but then I don't really want to add more income in 5-10 years time to that income earner. I want to disperse that to the one who doesn't earn as much. And of course, with the two names on there, you've got to decide that before you even enter the transaction, right?
Yeah, otherwise you're going to find yourself in a situation where you're transferring the title and paying stamp duty across to the other person.
And who wants to pay the government any more? We already pay them.
Yes, exactly. For the same transaction, basically.
For something you already own.
Yes.
So,
yeah.
Yeah, that's not smart. All right. So with that in mind, if it's a fairly, they're sort of earning the similar sort of thing and they do 50-50, you can build a portfolio. But how long can you build a portfolio for that? Like, can you do 2 properties, 3 properties? If they're, say, neutral or semi-positive geared, does that ever run out if it's in your own name?
What do you mean by run out?
Or your ability to keep financing?
Well, it'll obviously come down to the serviceability at the time. So banks will, take into consideration the rental income and the interest deductions and the deductions from tax. Their own servicing calculators work that out, and it really just comes down to that capacity to repay. Now, could you own 25 properties? Yes, you could, absolutely. But some banks will treat you differently if you do. So,
Yeah, okay.
So one bank, if you own more than 5 properties, they will treat you as a professional investor, and they'll start doing things like discounting the rent further than they normally would when they assess you, because they believe that you are rent reliant, which seems a bit silly to me because I'd rather be reliant on 6 properties than one job, but that's just the way it is.
Yeah. So really, once again, where I would think that banks would say, well, you own 5 more properties, you're one of our best clients, they start, penalising you.
They start limiting the income. Yeah. So they might say, well,
I love the banks.
Yeah. So for normally they might say for every $100 of rent, we're going to apportion 80% or $80 of that towards your capacity to repay. But they may start bringing that down to 70%. So you're losing 10% of the income that you could use to repay the loan, and which you are receiving. But
yeah, that's right.
They discount it.
Okay, so with that in mind, then is that the same situation when you go to another type of structure, like a company or trust or something? Like, what happens in that? Are you immediately classed as a professional investor, or they don't have that sort of same classification?
You're not classed as a professional investor just because you've got a company and trust structure. It's more about the amount of properties that you own.
Okay, so let me get this straight. So that's the amount of properties that entity owns. So if I had ABC company and it has 4 properties in, then it would be class. But if I went to 5 properties with that bank or something, they might say, well, now you're a professional investor. Is that what I'm understanding? Yeah. So what I could do is I could have 4 properties in ABC Co, and then I could have another 4 in XYZ Co, and we're never going to cross that sort of threshold, or do they group them all together?
No, they group them all together because you provided a personal guarantee across all of the debt load. And,
okay.
And when an assessment is done, it's done across all of your liabilities. And so you would call the loan in the company name your prime liability, if you like, for a better way to put it. and you provide the personal guarantee to that, so that's a contingent liability, and as a result, you could be called upon to pay that. So they will use it within your assessment, within the assessment process. So if you've got 4 companies, 16 properties, they want to know the details of all of those. You can't separate them.
Okay. So then we can't get around that. So why would we ever move to a company / trust or some other structure like that? So why would you ever do that?
Well, depending on your current employment and your asset protection strategy. So to give you an example, let's say that you run a business and you have some risk of being sued, or damage, having some damage occur where you are under attack personally, in litigation. Then you may be, part of that attack may end up in personal bankruptcy, and or you may have to liquidate your personal assets to repay some kind of litigation that's been made against you, which your insurance doesn't cover. So in that case, let's say someone's coming after you for your assets, then holding them in your personal name might be a very dangerous proposition for you.
Right, and this is what I touched on just before you jumped on, was about different structuring styles for tax versus asset protection versus retirement planning. And the lawyer would be focused on that sort of asset protection side. So, okay, so once again, these are the sort of decisions you got to make before you enter into a property, because even if you have it in your own name as with your wife or husband or spouse or whatever, and it's not very easy to transfer that into a company name down the track. There's a whole bunch of costs and redo.
Yeah, mainly stamp duty costs, obviously. I mean, there could be an argument to say that you shouldn't have any assets in your personal name, even a family home. And for those reasons, you've got trading risk and you've got that litigation risk. If you're running a business as, say, a sole trader, and which provides no legal protection, and you've got your own home in your own name, then you're at risk.
Yeah.
You're at risk of all of those things happening. Someone coming after you for your assets, and the only one you've got is your home, well, you're going to have to liquidate that.
Yeah. So if you're a risky person, such as perhaps me, who lives in the property space, then you really don't want things in your own name, right? And so if you're starting to build an active portfolio, you've got to think about this strategy and how much you are at risk. And I think that's a really good point you touch on. If you personally tick off enough people or do something, or you might not tick them off, you just could completely get blindsided by something in your career, then those assets are at risk.
Absolutely. I mean, people don't like to think about these things, but they happen,
Yeah.
So the building industry right now is under a lot of pressure and a lot of regulation, and for some builders, they are sole traders and they have their family assets in their own name, and if their building company collapses and they owe money to creditors, those creditors will come after them personally because they're a sole trader.
Yeah.
If there was a company in the middle of that, they could only come after the company and its assets, which is pretty much nil, right? So, or if the family home was in a company, then that person becoming personally bankrupt wouldn't impact on that entity.
Yeah. Okay. So what we've got 7 minutes left to go. So I just want to cover with you specifically the difference between whether it's paperwork or requirements or banks' view on you getting loans personally, as in the person, versus if you have corporate and trust structures. So we'll let the watchers decide which structure is best for them. But let's just outline the differences in terms of when you as a broker, if I come to you and say it's for my own name, you ask me for this, or if it's in a company, you're going to ask me for whatever. So just briefly outline the difference.
So if you're applying for a loan in your personal name, then we'll ask you for all of your personal information, your assets, your liabilities, your income, etc., including if you're running a business, your financial statements and tax returns. If you add a company and the company is trustee for a family discretionary trust, then we'll want details of that company and we'll want a copy of the trust deed itself. The bank will review that trust deed and make sure that it's a legally binding trust deed and that trust has the power to borrow money, which most do these days. I mean, I haven't seen one come back that doesn't, but some old trusts have some different kinds of clauses in them that banks don't like. The actual amount of information collected is not that much more. It's not that much more difficult. Where it does make a difference is if we're going to a particular bank and they charge you more for borrowing in a company in trust, then they would be the first one.
Okay. So the documentation is not particularly more onerous unless you've got multiple companies upon companies?
Yeah, that's right.
Yeah, okay. All right. So, then again, if you're doing that structure, you've either got lots of properties or lots of reasons to have those structures to protect assets, right?
Yeah,
So
I would be, if you're embarking on a property investment or any kind of asset purchase, I'd be talking to your accountant and your lawyer about a number of things. One is your tax planning. Secondly, asset protection.
Yeah.
And I know you mentioned retirement, but I'm going to throw in estate planning.
Yes.
Because sometimes people go and do a will in their personal name and they forget that they own their investment property in a trust.
Yeah.
Or it's not done correctly, and all of a sudden the assets in that trust are not theirs to give away anymore. So there's a number of reasons to get professional advice about the structures and determine which one is correct for you before you make that purchase.
Yeah, that's good. That's good. All right, so I think we've covered personal structures, and that we've covered the first investments, building a portfolio. Is there, apart from serviceability, if we're using companies and trusts to build portfolios, is there any limitation from finance, or is it just serviceability?
It's just serviceability. Yeah.
Okay.
But they don't really have an issue with how you're structuring it as long as they can capture the income.
Yeah. Okay. And as long as you do the personal guarantee.
Yes, which you'll have to.
Yeah.
You won't have a choice about that.
All right. Well, in the last few minutes, because you're across some of our projects, but we often get asked how we structure our projects, our micro and small projects that we do with our clients, because we always use companies and trusts, and of course the main reason is twofold. Firstly, we always create a new entity for a new project, so it's clean. And it's isolated, and that entity only does that project. And secondly, and on that point as well, then we shut it down at the end, so we get rid of it, so it doesn't exist any longer. And secondly, we do it for the asset protection side of things for both our clients, ourselves, and the project to once again isolate that. Yeah. So there's two different sides to what we do, and as you know, with our partners being involved, they have an entity as well, and a lot of times it's either a company or a unit trust. And we haven't touched on unit trust because they're so much fun, but those people have that structure on one side, which then loans some money to the development entity on this side, which has a different structure as a corporate and trust structure over here. So we use structures for all our projects. There's nothing ever done in their own names. And for all those people that ask those questions, all the reasons that Todd has said tonight are why. The asset protection, the ability to disperse funds as needed through the trust, whether it's a discretionary trust, whether it's a unit trust that's fixed. So do you give us a really quick overview of the difference between discretionary and a unit trust, Todd?
Well, yeah, a quick overview. So a unit trust effectively is an entity that a client or anyone would invest in, for want of a better way to put it, or buy units in, and those units have a value. And your distribution of income depends on how many units you own in the unit trust. So If you own 5 units of the 10 units, you're going to get 50% of the distribution.
Yeah.
A discretionary trust is exactly that. It's up to the trustee to decide who gets what from a beneficiary point of view. And that means that if there are 2 people involved, they may apportion 100% of the income across to one person and 0 to the other. It's discretionary. Whereas a unit trust, if I take a step back, as I said, it depends on how many units you own. So
Yes.
you must receive a certain amount through the unit trust according to what you own. In a discretionary trust, if you're a beneficiary, you don't have to receive any income at all. It could go to someone else.
And that's where we come back to with some of our clients when you and I both touched earlier on with the one high income earner and the one not so much. Some of them use those discretionary trust models to disperse that income to the one that doesn't have much income or any income, rather than going to the one that does. And that's a classic example of how to use those trusts and corporate structures to your advantage.
Yeah, absolutely. And that's the kind of information that you need to talk to your accountant about to get to plan that before you go into the project.
Yeah.
So you can take the forecast, the feasibility, provide them with your expected return so that they can map out, okay, well, if we put X dollars here, this is what your position is going to be, and give you multiple scenarios so you can decide on what structure is correct for you and how to apportion that income.
Yeah. All right. So one thing I didn't mention, we're going to call it a night pretty soon, but if there's any questions, log them in the sidebar and we'll get them answered live now as we do the wind up. If anyone's got any questions apart from commenting on my hair, that would be awesome. So what I will say is that, I'll reiterate again, talk to your lawyer, accountant and or financial planner on all these structure sort of questions, but you got to know it before you go to contract, right? There's not much point after the contract. You got to have all that sort of before you go to contract. You got to have the name right. It can be your own name. There's nothing wrong with that, but you got to know why you're doing it. You can't just do it because you didn't think of anything else. So look, I'd like to thank you tonight for joining us, everyone who's watching, and a special thank you to Todd. Mate, thank you. Todd is one of our preferred panel members at Xenium. So any of our industry partners that join our program and that get heavily screened, I must say, obviously not for technical ability, but for their knowledge, that's why he's here, right? He might not be able to drive a computer, but he has all the answers that you need. So if you need to speak to a lawyer or an accountant or a financial planner or a mortgage broker who's sitting on your screen tonight, you need to contact us at Xenium. We can put you in touch with all those people, the right people in your area. We'll have a quick chat to you, find out where you are, what you're chasing, and we'll give you a list of names and some of our, of course, preferred panel members. All right, there doesn't seem to be any more questions, which is fine. Obviously, my hair was the topic of the evening. Todd, thank you very much for joining us this evening. Mate, I know we'll see you again about something that's probably not so dry. And apologies to everyone, this is a dry topic, but it's really, really super important to get right because it not only could cost you massive amounts in stamp duty, but it could cost you your own assets if you don't. All right, that's it from us, our bonus 5th week in August, our bonus night on structuring from Xenium Real Wealth. I'm Scotty, and I'll see you next time.
Thanks, mate.